U.S. retail sales were up again in September, but at a slower pace. That's after several months of strong growth. Let's get more from Alex Grassino, Global Chief Economist at Manulife Wealth and Asset Management. Thanks very much indeed for joining us. I suppose we should start off with the caveat that this data is kind of stale and distorted because of the government shutdown.
It is. Generally speaking, when we look at the data right now, we lump it into three general categories. The first is the data's fine, but it's old. So it tells us what we needed to know about a month ago now. The second is data that will be distorted, either because they just didn't collect it or because it will have been affected by the government shutdown. And the third is getting back to normal. And we're certainly not there yet. We figure that happens sometime early in 2026.
Any patterns jumping out for you, though?
In the retail sales data, outside of generalized softness, which was undercut even more by strong gas station sales, which is usually driven by prices, to me, the important thing is you look at the end of Q3, which is softer. So you're going to see a lot of the nowcasting for GDP get revised down a bit. So slightly less upbeat than the 4% you've been seeing. And it also creates a bit of a softer handoff into the fourth quarter, which is starting to look a little bit softer than people might have expected even a couple of days ago.
Is retail sales data important to the Fed?
I think it is critically important because when you look at the trade-off between inflation and labor, part of what labor becomes is a general proxy for growth. And in the United States, the consumer really is the straw that stirs the drink. So you want that to stay healthy going through to the rest of the year. So at the margin, this will have reinforced the Doves case for the December 10th meeting.
And why would there be pressure on retail sales in the United States? I know the labor market has shown some signs of softness, but economic growth hasn't tanked.
It hasn't at all. So far, we think that the retail sales will actually, or general consumption will actually be fine over the next little while, but the generalized uncertainty from the shutdown will have affected the data for the next few months generally. And that is one of the things that we think could weigh. Also, you're looking at the lagged effects of tariffs perhaps starting to kick in a little bit. Again, we're not overly concerned about the U.S. economy at this stage, but we do think those things will weigh a little bit at the margin.
What consumer confidence obviously doesn't always reflect what's happening in the economy. Are Americans pessimistic right now?
So I think it's one of those climbing the walls of worry type things where if you look at consumer sentiment, it is at extremely low levels. And then when you look at what people actually do, i.e. voting with their wallets, they're still going out and spending. And I think that speaks to the resilience of the U.S. consumer generally. I think you discount the U.S. consumer at your own risk. I think it takes a real shift or a real shake in confidence for the consumer to actually stop spending. And it's beyond surveys.
And what about this much ballyhooed K-shaped recovery? Do you buy into the thesis that we often hear that lower income groups are faring much worse or significantly worse?
I do. I think there's considerable evidence of that case. The reality is at this stage that the top end of the K is driving the economy. So when you look at the overall data, it's a little bit of a head in the oven, foot in the freezer type of situation where there's a large group of people who are actually doing just fine and spending more. And then there is a separate group that is increasingly uncomfortable with where things are.
So does that matter in the sense that they have less money of course, it matters for them personally, and it's a question of income inequality and justice. But is that important for the economy that the lower income group are not doing well?
I would say ultimately it does, because if that tilts in or starts creeping up towards the middle of that K, so I guess that gap, what effectively happens is you will start to see a meaningful impact on overall economic growth. And I think what it will take is really for people to get increasingly more nervous about job prospects. I think if you're comfortable with your job, but you don't think you can get another one, you keep spending. If you start to worry about keeping your job, then maybe you start to tighten your belt a little bit. We're not quite there yet, but we do see the labor market looking tired at this stage.
And can you comment on tariffs? We keep hearing that despite all the fears in April that tariffs would be extremely disruptive, you remember the stock market slid. Is it fair to say that tariffs have not been that disruptive to the economy yet?
So I think this is an excellent point in distinguishing market pricing from macro lags. People look at tariffs and they assume they happen immediately, and you will see the effect in the next 2 to 3 months of data. I think what, in fact, you do see is a slow seeping into the broader data, and we're probably getting closer to that point now.
Right.
So it's sort of like you're in that gap at this stage.
Right. So the tariffs will have an effect, but there's still the lag.
Yes, I don't think it's going to be as extreme as people were worried about by any stretch, but I think you do get that sort of feeling of being underwhelmed at some point as you look at some of the data that comes through.
Could you just put it in perspective for us? Under the previous administration of Joe Biden, the government went ahead with massive support for industrial expansion in the United States. Mr. Trump, of course, has reversed some of Joe Biden's policies, especially in the area of renewable energy, for example. But do we have big industrial investment going on in the United States right now?
Oh, I think there's no question. If you look at areas like AI and you see new deals being printed almost daily, there is a lot to be excited about. The way we look at 2026 is we get through a 4 to 6 months where we're a little bit leery, not outright concerned, but it's sort of proceed with caution. And then as you get farther into the year, things like fiscal stimulus start to kick in, lower monetary policy starts to kick in. And frankly, just time, being used to the current operating environment will help people make decisions over the course of the year. And AI is certainly a massive contributor to that at this stage.
Will AI, go to 30,000 feet if you would. Will AI be as big as the advent of the internet over the next decade or so?
Hold up. Over the next decade, there's certainly a lot of potential there. I don't think it's going to be a vertical or a diagonal line up and to the right, though. I think there will be twists and turns in the story. But right now, we're certainly at a very exciting phase.
Thank you very much. I really appreciate it, Alex.